Hi and welcome to Lever Brothers tutorial on bearish wedges. Bearish wedges are small continuation patterns that represent brief pauses within already existing downtrends. They are characterized by converging trend lines and have a definite bearish bias. They are similar to bearish pennants except where pennants are generally flat, wedges slant against the overall trend and are often slightly bigger. The slight short-term move against the overall downtrend acts to sucker in new stockholders who believe they're getting a great deal by buying near the bottom, and it also causes many shorts to cover. Once these two groups are done buying, support in essence is removed and the stock can continue down. Bearish wedges typically appear in the middle of a large fall or immediately after a stock has broken down from a topping pattern. Downside breaks do not have the same volume requirement as their bullish counterparts. Like other bearish breaks, there is often a delayed volume surge. And if the pattern is small, we want to see it close below the low of the pattern to confirm the breakdown. Absent this, a defensive stance is warranted. For starters, the drop into the pattern can be used to establish an expected target. But again, this is just for starters and should not be relied on heavily. Some traders will measure a move to the far side of the pattern and project it down from the breakout level as shown here. Others will measure to the midpoint. There is no right or wrong answer. This isn't an exact science. Targets are meant to give you a frame of reference to work from. They are not set in stone. And when you're talking about the downside, ambitious targets are rarely hit. Let's check out a couple of examples to better highlight these concepts. Here's Copart. The stock dropped over 30% before moving into a bear wedge pattern. Volume was light when support was taken out but then ramped up. That's exactly what we want to see. The pattern was large, so a close below the low of the pattern was not needed. Notice how the price movement was temporarily turned back by the low of the pattern. That's not a bad place to take all or partial profits, especially if the overall market is moving up. Now let's talk about the target. The move from 24 down to 16 suggested a move from the mid-18s down to about $10. Such a move happens all the time when playing breakouts to the upside, but it's not realistic to expect the stock to drop almost 50%. Sure, it happens from time to time, but as a prudent trader, it's not wise to be greedy and hold out for such a drop. Instead, follow the stock down with a trailing stop and try to get the bulk of the move. Let's move on. Here's Dow Chemical. Within a newly formed downtrend, the stock traded into a small bearish wedge. Volume was average when support was penetrated and then ramped up as the downtrend continued. And like many downtrending stocks, it was not wise to expect a measured move to be hit because they rarely are. It's better to follow the stock down with a trailing stop while taking a few bucks off the table as the stock moves in your favor. Here's Dell. The stock had made a series of lower highs and lower lows when it formed a rising wedge within a downtrend. Once support was taken out, the stock fell 5 consecutive days. The move into the pattern was useless, suggesting a target as you can see here, because a new pattern formed. And in reality, even if you had held while the new pattern formed, you would have exited the stock when it attempted to move up, identified here with the 2 blue arrows. Let's go through a few more. We find it helpful to look at successful pattern formations to train our eyes. IBM was steadily trending down before pausing in a bear wedge and then continuing its drop. AMR was moving down when it squeezed into a rising wedge pattern which eventually resolved down. And here's AVCT. The stock got cut in half before moving into a bearish wedge and then continuing down to the lows of the pattern. That wraps up this tutorial. Again, bearish wedge patterns are brief pauses within downtrends. Ideally, volume will be average when support is taken out and then will ramp up as the stock continues to fall. The move into the pattern can be used as a guide to project a target, but that target is not set in stone.